Imagine owning a stock that can literally swing tens of percent in a single day, all because of one looming decision from the U.S. Food and Drug Administration. Just one decision dictating whether a flagship therapy will ever see the light of day. It is an incredibly high-stakes, dramatic story where science, big money, and the legal system are all crashing together in real time. Welcome to The Explainer. Today we're diving right into the heart of what might just be the ultimate binary bet in biotech. Let's get into it.
Section 1. The ultimate binary bet. How one FDA decision dictates everything.
So, we're looking at Capricor Therapeutics, ticker symbol CAPR. They're a clinical stage biotech company, and they are basically banking their entire future on a single therapy for a devastating, rare genetic disease called Duchenne muscular dystrophy. This is a condition that causes progressive muscle degeneration, and there's a massive critical need for new treatments. So you have to ask yourself, what exactly happens when a company's entire valuation hinges on one final FDA verdict? Well, Capricor is sitting dead center of a massive storm right now, ahead of their FDA target action date of August 22, 2026. They're getting squeezed by three enormous forces all at once: the dream of a transformative FDA approval, a really fierce dispute over their clinical data, and the sudden, jarring emergence of a securities fraud lawsuit from their own shareholders.
Section 2. The Crash and the Comeback. The extreme volatility of summer 2026.
To really grasp the immense pressure riding on that August 22nd date, we just need to look back at the sheer magnitude of the stock's drop this past summer. It's like a textbook example of how fast market psychology flips when regulatory winds change. On July 27th, everything shifted for Capricor. The FDA released briefing materials ahead of an upcoming advisory committee meeting, and those documents raised some seriously heavy concerns about whether the drug actually worked. And wow, the market reaction was violent. Capricor shares just collapsed, dropping roughly 64% in early trading. This wasn't just a missed earnings target, This was a direct strike at the core assumption holding up the company's entire valuation.
But hey, in the biotech world, a story's rarely over that quickly. Just a couple of weeks later, on August 14th, Capricor announced that the FDA was actually open to reviewing additional data for their lead therapy, Deramiocel. And just like that, the stock surged a massive 70% in a single day. The market wasn't trading on sudden new revenue. It was reacting purely to a rapid shift in the probability of getting that regulatory approval.
If we map out this absolute roller coaster of a summer, you really see how fast things escalate. You got July 27th with the FDA briefing drop and the big crash. Then, just 2 days later, on July 29th, the advisory panel holds their vote. Fast forward to mid-August, and that new data review sparks a massive comeback surge. And all of this is a countdown to August 22nd, the PDUFA date. That's simply the strict deadline for the FDA to make its final decision. It perfectly illustrates how a biotech stock's value is completely 100% tied to the perceived odds of tomorrow's approval.
Okay, let's talk about that July 29th advisory panel vote, because it is a super critical piece of this puzzle. The FDA's advisory committee voted 9-3, meaning 75% to 25% against the idea that the available data actually showed substantial evidence of effectiveness. 9-3, that was a brutal blow. But here's the absolutely crucial point. An FDA advisory committee does not make the final decision. The FDA does. So while a 9-3 vote against you is highly significant, it's not a final rejection, which of course is exactly why the stock could rally again in August.
Section 3. The dispute over data. Same numbers, different conclusions.
So you might be wondering, how on earth can a company and the FDA look at the exact same clinical trials and walk away with completely opposite conclusions? Well, let's look at the data Capricor brought to the table from their Phase 3 HOPE-3 trial, which enrolled 106 participants. According to the company, the trial was a success. It met its primary endpoint. They reported that their treatment was linked to a really impressive 54% slowing of upper limb decline compared to a placebo measured on what's called the PULS 2.0 scale. Plus, they hit a p-value of 0.03, which crosses that gold standard 0.05 threshold for statistical significance. On the surface, that sounds like incredibly powerful evidence for a disease that desperately needs treatments.
And this brilliantly highlights the golden rule of biotech. A positive clinical result does not automatically guarantee FDA approval. The FDA has to weigh the totality of the evidence. In Capricor's case, the FDA reviewers were scrutinizing the scientific justification for how the company analyzed the data, specifically taking raw changes, converting them into percentage changes, and then back again. Look, this isn't about anyone lying or making things up. It's a fundamental, deep-seated disagreement over study design, statistical methodology, and the sheer volume of proof required to declare that a drug definitively works.
Section 4. Ticking clocks and legal trouble. The financial and legal pressure mounting on CAPR.
While they're fighting this complex regulatory battle, Capricor is also racing against a relentless cash burn clock. Any biotech company waiting on an approval has to spend huge amounts of money preparing for commercialization, long before they ever see a single dollar of sales. Just look at the numbers. In the second quarter of 2025, their net loss was $25.9 million. By the second quarter of 2026, that quarterly loss had ballooned to $40.7 million. That is a staggering 57% year-over-year increase, driven mostly by a 55% jump in their operating expenses.
And spending at that rate takes a massive bite out of their war chest. At the end of 2025, they were sitting on a very healthy $318.1 million in cash and investments. But fast forward just 6 months to June 30, 2026, and that pile shrank to $237.9 million. To put that in perspective, that's a rapid 25% drop, over $80 million gone in just half a year. Why is this so critical? Because if the FDA delays or outright rejects the drug, this financial equation goes from tight to incredibly difficult. The company could be forced to raise more money, which directly dilutes the current shareholders.
And, as if burning through cash wasn't enough, we've got a whole new layer of complexity to deal with. A securities fraud class action lawsuit has actually been filed against Capricor by its own shareholders, focusing on statements made between December 2025 and July 2026. The lawsuit claims the company's statements about its clinical data, statistical analysis, and FDA pathway were misleading. Now, I want to be absolutely 100% clear on this. These are strictly allegations right now. Just because a lawsuit is filed does not mean any court has found actual fraud, but for sure, it throws a dark, heavy cloud of uncertainty right over the stock.
Section 5. The August 22 Countdown. Bull versus bear and the 3 possible outcomes.
All of these intersecting forces, the complex clinical science, the intense cash burn, the looming legal battles, they all bring us to the ultimate climax of this story. Right now, there are 2 fiercely distinct viewpoints in the market. The bull case is optimistic. The HOP3 trial hit its primary endpoint, the FDA is actively reviewing fresh data, and a thumbs up would instantly transform Capricor from a cash-burning research lab into a revenue-generating commercial powerhouse. But then you have the bear case. They point straight at the FDA's own reviewers raising red flags, that painful 9-3 negative panel vote, a 55% spike in operating expenses, and the messy distraction of pending litigation.
So, heading into August 22, investors are staring down 3 very distinct scenarios. Step 1, FDA approval. This literally transforms the company's prospects and valuation overnight. It's the grand slam. Step 2, FDA rejection. This absolutely crushes the current investment thesis and forces everyone to totally reassess what the company is actually worth. Step 3, delay or additional requirements. This kicks the can down the road, which dramatically cranks up the pressure on that ticking cash burn clock we just talked about. And remember, we're outlining possibilities here, not making predictions.
Honestly, Capricorn is just the perfect illustration of why the biotech sector is so uniquely volatile. You can have a genuinely promising therapy, hundreds of millions in the bank, and still watch your value get sliced in half in a matter of hours. Because investors aren't buying today's business, they're buying the probability of tomorrow's regulatory approval. As we watch the clock tick down to August 26, it leaves us all pondering a fascinating question. When clinical science, strict FDA regulation, massive cash burn, and the legal system all collide, what is the true price of tomorrow's approval? Ultimately, it's a multi-million-dollar question that only the FDA can answer.